Visa just announced that it's cutting nearly 2,600 jobs. If you only read the headlines, the conclusion seems obvious. Slowing growth. AI replacing workers. A company preparing for tougher economic conditions. But what if those headlines completely miss the real story? Because in the very same week, Visa also reported another outstanding quarter. Revenue continued to grow at a double-digit pace. Payment volumes remained strong. Cross-border spending accelerated. Earnings beat Wall Street's expectations. So here's the question investors should really be asking. Why would one of the most profitable, highest margin, and most dominant payment companies in the world cut thousands of jobs when its core business is performing so well? Is this the first sign of weakness? Or is management quietly reshaping Visa for the next decade of growth? Today, we're going beyond the headlines, separating market noise from business reality, and uncovering why what looks like bad news today could actually become one of the most bullish signals long-term investors shouldn't ignore. The moment Visa announced it was cutting nearly 2,600 jobs, the market reacted exactly as you'd expect. Many investors immediately assumed the company was facing slowing growth, weaker consumer spending, or pressure from artificial intelligence. But as equity investors, our job isn't to react to headlines, it's to understand what the headlines are missing. Because layoffs, by themselves, don't tell us whether a business is getting weaker or becoming more efficient. A company in decline cuts costs simply to survive. A great company restructures because it sees an opportunity to allocate capital more effectively and stay ahead of the competition. These may look similar on the surface, but they lead to completely different investment conclusions. So before we judge Visa's decision, let's ignore the headlines for a moment and examine what the underlying business is actually telling us. If Visa's business were actually weakening, we would expect to see it in the numbers long before we see it in the headlines. But that's not what happened this quarter. Revenue grew 14% year-over-year, showing that consumer and commercial spending remained resilient. Payment volume increased another 10%, indicating that people and businesses continue to rely on Visa's network every single day. Even more impressive, cross-border volume grew 13%, a strong sign that international travel and global commerce are still supporting the business. On top of that, Visa once again delivered earnings above Wall Street's expectations. These aren't the financial results of a company under pressure. They're the results of a business that continues to execute at an exceptionally high level. Which makes the layoffs even more interesting, because the numbers suggest this decision wasn't driven by weakness, but by something much more strategic. One of the biggest misconceptions about Visa is that it's a bank. It isn't. Visa doesn't lend money to consumers, and it doesn't carry billions of dollars in loans on its balance sheet. Instead, Visa operates one of the world's largest payment networks, connecting consumers, merchants, banks, and financial institutions across more than 200 countries and territories. Every time someone uses a Visa card to make a purchase, the company earns a small fee for facilitating that transaction. That means Visa's success depends far more on the growth of global payment activity than on interest rates or loan defaults. It's an asset-light business with extraordinary operating leverage. As more payments move from cash to digital, Visa can process more transactions without increasing costs at the same pace. That's one of the key reasons why Visa has consistently generated exceptional margins, strong free cash flow, and one of the widest economic moats in the financial industry. At first glance, cutting 2,600 jobs looks like a traditional cost-cutting program. But management's message tells a very different story. Visa isn't shrinking because demand is weakening. It's restructuring because the payment industry is changing faster than ever. Artificial intelligence is automating routine tasks. Digital commerce is becoming more complex. New technologies, from tokenization to stablecoins and intelligent payment systems, are reshaping how money moves around the world. Rather than simply reducing expenses, Visa is reallocating talent and capital toward the areas that will define the next generation of payments. In other words, this isn't about saving money for the next quarter. It's about investing resources where they can generate higher returns over the next decade. That's a very different message from the one suggested by the headlines. Artificial intelligence isn't the biggest challenge facing Visa. The real question is whether new technologies can bypass Visa's network altogether. Around the world, we're seeing the rapid development of stablecoins, real-time payment systems, and open banking infrastructure. Some believe these innovations could reduce the need for traditional card networks in the future. But replacing Visa is far more difficult than building a faster payment technology. Visa isn't just software. It's a trusted global network connecting thousands of financial institutions, millions of merchants, and billions of payment credentials across more than 200 countries and territories. That network has been built over decades through trust, security, regulatory compliance, and global acceptance. Technology can change quickly. But rebuilding an ecosystem of this scale is an entirely different challenge. That's why the real debate isn't whether AI exists, it's whether anyone can realistically replicate Visa's global network. The strongest companies don't wait for disruption to happen. They invest before disruption becomes a threat. That's exactly what Visa appears to be doing. While its core payment network continues to generate exceptional cash flow, the company is expanding into faster-growing businesses that extend far beyond processing card transactions. These include value-added services, commercial payments, fraud prevention, AI-powered payment solutions, and cross-border commerce. Together, these businesses deepen Visa's relationships with banks, merchants, and enterprise customers while creating new sources of recurring revenue. In other words, Visa isn't simply trying to process more payments. It's becoming a larger part of the entire payments ecosystem. If management is reallocating talent and capital toward these higher growth opportunities, then the recent restructuring may not be a sign of weakness at all. It may be another step in expanding Visa's competitive moat for the decade ahead. Financial markets often react to headlines before they fully understand the underlying story. The word layoffs immediately creates fear because investors naturally associate it with slowing growth and declining demand. But that's a psychological reaction, not necessarily an analytical one. Long-term investors ask a different question. They don't focus on how many employees a company lets go. They focus on whether management is improving the business's ability to generate higher returns on capital. If a company can streamline its operations, invest more aggressively in future growth, and strengthen its competitive position, then short-term uncertainty can actually increase long-term intrinsic value. That's why great investment opportunities often appear when the market is focused on today's headlines instead of tomorrow's economics. Whether Visa fits that description is exactly what investors should continue watching over the coming quarters. Despite its dominant position, Visa is far from invincible. The biggest long-term risk isn't a recession or weaker consumer spending. It's the possibility that new payment technologies allow money to move without relying on traditional card networks. Stablecoins, account-to-account payment systems, and government-backed real-time payment infrastructure all have the potential to reduce friction, and in some cases, bypass parts of Visa's ecosystem. Regulatory pressure is another challenge. Around the world, governments continue to examine interchange fees, network competition, and the market power of large payment companies. None of these risks are likely to transform the industry overnight. But together, they could gradually pressure Visa's pricing power and long-term growth if management fails to adapt. For investors, the key question isn't whether these threats exist. It's whether Visa can innovate faster than the industry changes. Over the next few quarters, investors shouldn't obsess over how many employees Visa has. Instead, they should focus on the metrics that actually determine long-term shareholder value. First, payment volume growth. As long as consumers and businesses continue spending through Visa's network, the core engine remains healthy. Second, cross-border volume. This business generates some of Visa's highest margin revenue, making it a critical indicator of pricing power and global economic activity. Third, the growth of value-added services. This is where Visa is expanding beyond payment processing into fraud prevention, data analytics, and AI-enabled solutions that deepen customer relationships. Finally, watch operating margins and free cash flow. If Visa can continue improving efficiency while maintaining strong profitability, then the recent restructuring may prove to be an investment in future returns, not simply a reduction in costs. These are the numbers that will tell us whether management's strategy is actually working. After looking beyond the headlines, a different picture begins to emerge. Visa's core business remains exceptionally strong. Consumer spending is healthy, cross-border payments continue to grow, and the company still generates industry-leading margins and free cash flow. Those aren't the characteristics of a business fighting for survival. They are the characteristics of a company operating from a position of strength. The recent workforce reduction appears less like a defensive response to weakening demand and more like a strategic decision to reallocate capital toward the next phase of growth. Of course, execution will determine whether that strategy succeeds. But history shows that many of the world's highest quality businesses invest and restructure while they're winning, not after they've already fallen behind. For long-term investors, that's the question worth following over the coming years. At the beginning of this video, we asked a simple question. Why would one of the world's most profitable companies cut thousands of jobs while reporting another strong quarter? After examining the business, the answer appears to be very different from what the headlines suggest. The evidence doesn't point to a company in decline. It points to a company repositioning itself for the next phase of digital payments. That doesn't mean the risks have disappeared. Stablecoins, real-time payment networks, regulatory pressure, and new technologies will continue to challenge Visa over the coming years. But history has shown that companies with wide economic moats don't protect their leadership by standing still. They strengthen it by adapting before change becomes unavoidable. For now, Visa's layoffs look less like a warning sign, and more like a capital allocation decision made from a position of strength. Whether that decision ultimately proves bullish will depend on one thing: management's ability to turn today's restructuring into tomorrow's competitive advantage. And that's exactly what long-term investors should be watching. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.